And we have finally made it to the fair value gap lesson. Ladies and gentlemen, I know a lot of you have been waiting for this exact lesson. So we're going to get into exactly what a fair value gap is. You probably heard about me talk about this a million times, but we're going to get into the actual technical definition. So, quite simply, what is a fair value gap? Well, a fair value gap is an imbalance in price. So it's an imbalance / inefficiency. You also might have heard it referred to as a PD array. What is a PD array? Premium / discount array, right? When it's in a premium, it's a sell PD array. When it's in a discount, it's a buy PD array, or just relative to where it is. Usually these form in a discount or a premium. So, with that being said, those terms are interchangeable. Just understand that when we're referring to fair value gaps, order blocks, breaker blocks, liquidity voids, stuff like that, those are all imbalances / PD arrays, otherwise known as inefficiencies. You can call them whatever the fuck you want. Back to the point. Price will eventually want to revisit this area in order to rebalance the market. When it moves so fast, it does not offer the other side of the market. So in a buy context, we only offered buy side, and a sell context, we only offered sell side. So price will eventually want to draw back to that. It's kind of like when you're painting a wall, right? You'll paint a wall, you'll do a pass through, but when the paint runs out in certain areas, there'll be gaps if you move too fast. Same thing with price. Price will move fast, leave those gaps. It'll want to come back, roll over those areas, smoothen them out, and rebalance them. So a bullish fair value gap is a 3-candle formation where price leaves an imbalance or a gap between the high of candle 1 and the low between the high of candle 1 and the low of candle 3. So you can see right there, price, candle 1, that's the high, candle low of 3. And then in between that is the fair value gap. Now, in a bearish formation, this is between the low of candle 1 and the high of candle 3. So there is the gap in between, and that is a bearish fair value gap. Fair value gap. Now, there are some other nuances to these gaps, but real quick, we're going to go ahead and hop on the charts here and see if we can find a couple. So right off the bat, you can see we have a fair value gap right here. And it looks like we're actually trading off of that fair value gap right now. So that is a 15-minute fair value gap. You can see up here, there is also a 15-minute fair value gap. And you see how well price respects and reacts to that level. Now, we don't know if this gap is going to get fully respected yet, but so far this is pretty good respect of this gap. Now, let's go ahead and move to another area in price. So over here as well, we had a fair value gap. On the bullish side, you can see that price respects that a couple times, ultimately goes up. So that is a fair value gap as well. And then what do we have right here also? Candle 1, candle 2, between the high and the low. That is a fair value gap. And that is a bearish fair value gap. So whenever price displaces down, like we were saying, that's the bearish gap between the low of candle 1, high of candle 3. Whenever we go bullish, it's a displacement up. And you see between the high of candle 1, low of candle 3. So those are fair value gaps, guys. We will be getting into further concepts of it real quickly. I'm just going to try to show you. I don't know exactly if we got an example here, but we should have some sort of example on the lower time frame to show you guys. So this is how we begin to take entries. We're not going to get too much into entries yet, guys. We're going to do that in a future video. But you can see after we trade into that fair value gap, what do? We respect it, guys. And what else do? We displace. What is that? Market structure shift. Remember from yesterday's lesson? So we left a market structure shift there. What else did we leave behind, guys? We left behind fair value gap here. Didn't really get that respected, but we also left behind a fair value gap here. You can see that way later on, guys. We ended up using that fair value gap. See how perfectly it respects it before running straight up. And then if you miss that fair value gap, There's a fair value gap right here. See, it barely gets traded into, but nonetheless, it gets traded there. And then we have another fair value gap there on the 1 minute. And you can see it runs off of that level as well. So you're starting to see the power of these fair value gaps, especially when you start to layer them with the higher time frame and the intraday gaps. So in this example, we had a 15-minute fair value gap. We had a market structure shift off of that fair value gap that left a fair value gap on the 1 minute. And then we had a 1 minute entry right there. And then even further, we had a break of structure and a market structure shift, both with fair value gaps that delivered to the bullish side as well. Now let's go over here, see if there's an example on the sell side. So we trade up into that 15-minute fair value gap, guys, right here. Boom, we do make an IFVG. We'll talk about that in just a sec. We come up here and we finally shift market structure there. And then we come up to make another market structure shift right there. Now, I would count more of this as a market structure shift because this is still within like this price leg right there. But you can see after we made that shift, what did we leave? Left a pretty significant 1 minute bearish gap. You can see it sells off of that once, twice, over 3 times, guys, before dropping down. So see the power of fair value gaps when you start to layer them through the different time frames, guys. But now you understand exactly what those are. It's simply the inefficiency between that 3 candle pattern. Now let's go ahead and move on. And why exactly are fair value gaps important? Well, we just showed you how to use them in an entry context, but they can also be used for targets, for bias, etc., draw on liquidity. So we're going to also hop on the charts and take a look at that. Let's go ahead and go back to the charts right here. We can actually use this as an example, probably see what happens off of maybe say this fair value gap right here. So if we were to take this one and maybe aim for those highs up there, that's a 1 to 2. And then we can go up to the 15-minute to see if there was anything there that we were targeting. So in this particular example, it does not look like there was a fair value gap to target, but it does look like there was an order block to target. And we're going to learn more about that as well. So for this example, we didn't necessarily have a fair value gap target, but we did have this order block target up here. But let's take a look at this example right here, because this is actually a model I trade, the retracement model. It's retracing into this fair value gap right here. So this could have been used as a target to go short. So if we drop down here, you guys can see we left that high. We come up here. We sweep this high. And then you could see from here to the top of that 15-minute gap, that's a 1 to 1.98. So it's a 1 to 2 down to consequent encroachment is a 1 to 3. And we'll see if that happens. So it does deliver the 1 to 3, guys. And that was our draw on liquidity / target. So had this not been there, price probably would have continued going up. And we're going to talk more about that in a future video. But you can see even after price does touch that, it wants to shoot up as well before, retracing and making another move. However, this move in particular, guys, was very nice to that 15-minute fair value gap. I know it looks like a small move on the 15, but that's really all you need, guys. That's really all you need. Now let's take a look at a daily example. In this example, we had a daily fair value gap up here. So this is actually a daily bearish gap that we had. And let's drop down to see what the response was from that level. So you can see here, it does trade up into that bearish level. And then what do we have after it trades to the bearish level? So after we reject here, what else do we have? Well, we have a fair value gap down here. This was already traded to, however. We have an order block right there. We'll learn about that in the next lesson. But we also had a 4-hour fair value gap. So we had a 4-hour fair value gap down here. We're also in a premium rejecting a order block. And you can see we dropped straight to that 4-hour fair value gap. So that could have been a potential entry as well, guys. This was a little bit of a quick entry, but nonetheless, it did offer quite a nice move there as well. And you probably would have needed at least a 15-point stop for that one, but you can see it delivers straight to that 4-hour gap from that daily. So we use both a daily level, a daily fair value gap, and a 4-hour fair value gap. We use the daily for our entry, 4-hour for our target. If you wanted to refine that even more, you could go down to the 1-minute time frame. You could wait for the displacement off the daily fair value gap, wait for the market structure shift right there, You can see market structure shift in the bearish side, and then you could have teed off on a 2022 model. And that one played out very, very nicely that day to that fair value gap. So that is just a plentiful of ways of how to put the fair value gaps together, guys. How to use them for entries, targets, bias, 1-minute entries, 15 minutes to frame your entries off of. This is all the different ways you can use it, and we're going to go even deeper in the future lessons. So now that you understand that, we'll go to another concept, which is fair value gap consequent encroachment. Now, fair value gap consequent encroachment is simply the midpoint of a fair value gap. So if you take your equilibrium tool and grade a fair value gap, the middle point is the consequent encroachment. And I'll show you how to turn that on as well on TradingView. But just so you guys know, it is the 50% point between the high and the low of the fair value gap. And when this respects on close, when the candle respects this level on close, price is usually likely to respect the direction and continue in that direction. But when it doesn't, and you see candles closing past this or displacing past this consequent encroachment, that is a sign that the gap may fail. So we'll go ahead and show you how to turn that on as well. Basically, all you got to do, because when you use this rectangle tool by default, it'll have this turned off. It'll look like this. So what you got to do is just double click that, go to style, and then go to middle line. You can adjust the opacity, you can adjust the color, but that'll put that middle 50% line on your fair value gap. And you just want to see that get respected. It doesn't always happen, guys, and it'll still deliver, but in the most bullish scenario, you'll see the fair value gap consequent encroachment get respected, just like in this example right here. You can see that big bullish run, and you saw none of the candles close past that consequent encroachment. See, we wicked past it. We even wicked way past it, but we still respected that on close. So did this candle, so did this candle, and we continued up from there. So that's a very good sign. Also on the sell side, you can see on this gap right here, until we started to buy up, you can see how well all of those respected it too. And it's even more directional if it doesn't even reach for it. Like if you have a situation like this, like on the daily, where we're super bearish, you don't even reach for that consequent encroachment. You'll just sweep the top of it. So that's another way you can use that. But ultimately, what you want to see when your direction is getting respected is you just want to see that consequent encroachment. You don't want to see any candles closing past that. And just like in here on that bearish gap too, up there. But that is fair value gap consequent encroachment. Now, there's one last concept I want to introduce to you guys. I thought about doing this in its own lesson, but it kind of just makes more sense to do it in this one. And that's the concept of inversion fair value gaps, or IFVGs. So a lot of you have probably heard this. Maybe you've seen my other strategy video. So what is an IFVG? Well, an IFVG signals a potential reversal in the opposite direction. So this is just like the market structure shift, change in the state of delivery. An IFVG is actually a type of change in the state of delivery. So signals that price could be moving the other way. We can use this as an entry confirmation for bias and to decipher order flow. So all the ways you use a regular fair value gap, you can also, on the opposite side, use an IFVG. So bullish side, you'll see a bearish fair value gap form, and a bullish candle will close through it and disrespect it. Vice versa for bearish, you'll see a bullish fair value gap and a bearish candle displace and close below it. So that is an IFVG. Now, what is a valid and what is not a valid IFVG? Well, it's not valid if we just do a huge wick, but we don't actually close through it. This is actually a very bearish sign. And it's not good if we also just barely inch by it and close in a very weak candle formation. That is also not very good. It can mean we're actually entering consolidation profile rather than reversing. So it must have a clean displacement. See how big these candles are? See how good and strong the close is? That is what you are looking for on your IFVGs. So displacement is a key factor in ensuring that this is a true reversal, not just a deep retracement. It's not that it can't deliver without it, but it's just lower probability if you don't have a displacement. So let's go ahead and go on the charts and look at a few examples of this as well. We might actually have one right here. So if we delete this cell right here and we bring our attention to earlier in this day, you can see that after we reach down to sweep that low, And we're also, guys, keep in mind, we're also still in a 15-minute bullish fair value gap. We swept a low, right? We also closed and displaced past the high of that bearish fair value gap. So that is now an inversion fair value gap. A lot of traders would go ahead and get in a trade there, stop loss below the IFVG candle, and they go ahead and target that high. And then next they might target, some of these other highs to the left. So that is the IFVG model. You can see ultimately it draws all the way up to that daily. So that's another example, guys. You took a trade from a 15-minute gap, correct? 15-minute bullish fair value gap. You had a draw on liquidity in the form of a bearish daily fair value gap. So you knew price was likely going to retrace there to continue down. You had an IFVG after a sweep of liquidity, after a displacement and inversion. You also got a displacement here with a market structure shift and continued all the way to draw to that gap. So you had an entry point of interest, 15-minute fair value gap. You had an IFVG on the 1 minute as your entry confirmation, and you had a daily fair value gap on the bearish side as your draw on liquidity. This is a full and complete entry. So don't go ahead and start getting ahead of yourself and getting into too many entries yet, guys. We still have a lot to break down, but just so you see how this works, it is very, very mind-blowing once you start to understand these concepts. Now let's take a look at another example, guys. Let's actually go to an example from yesterday. I didn't end up taking this because I don't trade IFVGs. I took the sell right before it. But you can see over here, we trade into a fair value gap. What kind of fair value gap is that? That is a bullish 15-minute fair value gap. And what did we do after we traded into that? Boom. We left a bearish gap, and then we displaced and closed above that gap. Now in this scenario, we did close quite a bit above it, so it does leave you with kind of a wide stop loss. Still could have taken that though. Stop loss below there. Could have had your first target be at the high or these highs right here, and then you can have TP2 more like a 1 to 2, 1 to 3. I think it reached for a maximum of like a 1 to 2.5 this day. But you see, fair value gap for your entry point of interest on the 15, inverted fair value gap, and then you took the long, and then it was even up to another fair value gap. That was small one up here. I don't know if it exactly got to that point that day. No, it didn't. But you can see we had plenty enough to go ahead and get in that. And if you held long enough, it gave you an extended run. So beautiful, guys. Beautiful, beautiful. We went over a ton of setups. We went over IFVGs, regular fair value gaps, consequent encroachment, how to view if it's respecting the midpoint, and we even got into some entry models and how to layer these gaps on different time frames. So don't want to get too ahead of ourselves. The assignment for this lesson is going to be to find 10 examples of fair value gaps and inversion fair value gaps in the chart during your session. So during whichever session, New York, Asia, London, that you've chosen to trade, gather 10 examples of both of these concepts. Bonus points if you can start mapping the 15 to the 1 and finding entries using these concepts, but you don't have to feel the need to do that right away quite yet. Other than that, guys, appreciate you being here. And if you check the Discord, I have announced the winner of the $100 giveaway. So congratulations to the winner. You have been selected by now, and by now you should have already received your money. So comment below, day 14 complete. We are almost halfway there, and tomorrow will mark the halfway point. It's been an amazing journey so far, and we're only going to continue to go harder and make these lessons even more value packed. So I'll see you guys in the next one. Take care, everyone, and have a blessed night.